Analyzing a stock professionally does not begin with a price chart, a social media recommendation, or a list of popular valuation ratios. It begins with a process. The objective is not to prove that a stock should be purchased. The objective is to understand the business well enough to decide whether the potential return justifies the risks and the current price. The framework in this video has 6 major stages. First, understand how the company makes money. Second, evaluate the industry, competitive position, and durability of its advantages. Third, examine management and how capital is allocated. Fourth, connect the income statement, balance sheet, and cash flow statement. Fifth, estimate what the business may be worth under realistic assumptions. Finally, identify the risks that could permanently damage the investment thesis. This creates an important distinction. A great company is not automatically a great stock. A wonderful business purchased at an extreme valuation can produce disappointing returns. A mediocre company purchased cheaply may still be a bad investment if its earnings and competitive position continue deteriorating. Professional analysis connects business quality with financial strength, valuation, and risk. It also accepts uncertainty. No spreadsheet can predict the future perfectly. The goal is to create a range of possible outcomes, understand what must go right, and avoid paying a price that assumes everything will go right. By the end of this process, the answer does not always need to be buy. A professional conclusion may be buy, watch list, or pass. And the first step toward reaching that conclusion is understanding the company without using financial jargon. How does the business actually make money? Before looking at revenue growth or the price-to-earnings ratio, I want to explain the business in 1 or 2 clear sentences. Who is the customer? What product or service does the customer purchase? Why does the customer choose this company? And how frequently does that customer return? These questions reveal the economic engine behind the numbers. A subscription business may generate recurring revenue every month or year. A retailer depends on the number of transactions, the average purchase size, and the margin earned on each sale. An advertising company depends on attracting an audience and convincing advertisers that access to that audience is valuable. A licensing business may generate high-margin revenue from intellectual property without manufacturing every product itself. The business model also determines which metrics deserve attention. For a subscription company, I may study customer retention, recurring revenue, and acquisition costs. For a manufacturer, production capacity, input costs, and inventory may matter more. For a bank, deposits, loan quality, and net interest margins are more useful than traditional measures of free cash flow. I also want to know whether revenue is concentrated. If one customer represents a large part of total sales, losing that relationship could materially damage the company. The same applies to one product, one geography, or one distribution partner. A company can look diversified from the outside while depending heavily on one hidden economic driver. If the business cannot be explained simply, the analysis is not ready to move forward. Once the revenue engine is clear, the next question is whether competitors can copy it, undercut it, or make it irrelevant. That takes us from the business model to the company's industry and competitive advantage. A fast-growing market can attract investors, but it also attracts competitors. That means industry growth alone does not guarantee strong shareholder returns. I first examined the size of the opportunity. How large is the total market? Which portion can the company realistically serve? And how much market share would be required to justify the current valuation? A company does not need to dominate an entire industry to succeed, but the expected growth should be economically possible. Next, I examined competitive advantage. A low-cost producer may survive price competition better than its rivals. A network effect becomes stronger when each new user makes the product more valuable to other users. A trusted brand may allow the company to charge a premium. High switching costs can make customers reluctant to leave because replacing the product would be expensive, disruptive, or risky. Intellectual property may protect a technology, process, or product for a period of time, but investors should be skeptical of the word moat. A real competitive advantage should appear in the financial results. It may produce high customer retention, attractive returns on capital, stable market share, or margins that competitors struggle to match. I also study the forces working against the company. New competitors may enter, customers may demand lower prices, suppliers may increase costs. A substitute product may change the industry. Regulation may reduce profitability or increase compliance expenses. The most valuable advantage is not the one that sounds impressive in a presentation. It is the one that protects economic returns over time. But even a company with a strong competitive position can destroy value when management makes poor decisions. So after understanding the moat, the next step is evaluating the people responsible for using the company's cash. Management quality is difficult to measure because executives know exactly what investors want to hear. That is why I focus less on promises and more on decisions. The first question is whether management consistently executes its stated strategy. If leaders repeatedly lower targets, change explanations, or blame temporary conditions every year, credibility becomes weaker. The second question is whether incentives are aligned with long-term shareholders. Insider ownership can be positive because executives participate in both gains and losses. But stock-based compensation can weaken that alignment when executives receive large awards while shareholders are continuously diluted. The most important test is capital allocation. A successful business eventually generates cash, and management has several choices. It can reinvest in the existing business, it can purchase another company, it can reduce debt, it can pay dividends, or it can repurchase shares. None of these choices is automatically good. Reinvestment creates value only when the expected return is attractive. Acquisitions can accelerate growth, but they can also hide weak organic performance and produce expensive write-downs later. Debt reduction may be the best use of cash when the balance sheet is fragile. Dividends can be appropriate when profitable reinvestment opportunities are limited. Share repurchases create value when shares are purchased below a reasonable estimate of intrinsic value. They may destroy value when management buys aggressively at inflated prices or merely offsets employee dilution. I also compare management compensation with performance per share. Revenue may be rising while earnings or free cash flow per share remain stagnant. That is not the same as creating shareholder value. Management's words help explain the plan. Capital allocation shows what the plan actually prioritizes. After evaluating those decisions, we can move from management behavior into the financial statements, starting with the income statement. The income statement explains how revenue becomes accounting profit. We begin at the top with revenue. I examine the growth rate, but also the source of that growth. Did the company sell more units, raise prices, acquire another business, or benefit from a temporary market condition? After revenue comes the cost of producing the product or delivering the service. Subtracting that cost gives us gross profit. Gross margin helps reveal pricing power and production efficiency. An improving gross margin may indicate stronger pricing, lower input costs, or a more profitable product mix. A declining margin may signal competition, discounting, or cost pressure. Next come operating expenses, including sales, marketing, research, administration, and other costs required to run the company. Subtracting these expenses gives us operating income. Operating margin tells us how much profit the core business produces before interest and taxes. If revenue is growing faster than operating expenses, the company may have operating leverage. But operating leverage works in both directions. When revenue slows, fixed costs can cause profits to decline faster. At the bottom is net income, which includes interest, taxes, and other non-operating items. I also examine earnings per share, but EPS can rise because of actual business improvement or because the company repurchased shares. That is why I compare revenue, operating income, net income, and share count together. One strong quarter is not enough. I prefer several years of results to identify whether growth and margins are durable or cyclical. The income statement shows profitability. It does not tell us whether the company can meet its obligations during a difficult period. For that, we need to move to the balance sheet. The balance sheet answers a simple but critical question. Can the company survive when conditions become worse than expected? On one side are the assets. These may include cash, investments, receivables, inventory, property, and intangible assets. On the other side are liabilities, including supplier obligations, leases, short-term borrowing, and long-term debt. Shareholders' equity represents the accounting difference between assets and liabilities. I begin with liquidity. How much cash and short-term investment does the company hold? How much debt or other obligation must be paid during the next year? The current ratio can help, but it should not be used without understanding the assets. Inventory may not be easily converted into cash. Receivables may be difficult to collect. A company can report adequate current assets while still experiencing liquidity pressure. Debt analysis should include more than the total balance. I want to know the interest rate, whether the debt is fixed or variable, and when each obligation matures. A company with manageable total debt can still face danger if a large portion must be refinanced during one difficult year. Net debt compares debt with available cash. Interest coverage compares operating earnings with interest expense. Both are useful, but neither replaces a maturity schedule. The balance sheet also reveals dilution and acquisition history through changes in share count, goodwill, and intangible assets. A profitable company can fail when it cannot refinance debt or access enough cash to continue operating. A strong balance sheet gives management time to solve problems. A weak balance sheet turns temporary problems into permanent losses. But accounting profit and financial strength still do not tell us how much cash the business actually produces. That is the job of the cash flow statement. Net income is an accounting measure. Cash flow shows more clearly what happened to the company's money. The cash flow statement begins by reconciling net income with cash generated from operations. It adjusts for non-cash expenses and changes in working capital. If receivables increase, the company may have recorded revenue without collecting the cash yet. If inventory rises, cash has been used to produce goods that have not been sold. If accounts payable increases, the company may temporarily preserve cash by delaying payments to suppliers. Operating cash flow, therefore, helps us test the quality of reported earnings. From operating cash flow, I subtract capital expenditures to estimate free cash flow. Free cash flow is the money available after maintaining and expanding the physical or technological assets required by the business. This cash can be used for acquisitions, debt reduction, dividends, buybacks, or future investment. I compare free cash flow with net income over several years. They do not need to match every quarter. Working capital and investment cycles can create legitimate differences. But when net income consistently rises while free cash flow remains weak, the gap deserves investigation. Capital expenditure also needs context. Low capital spending may temporarily increase free cash flow while the company underinvests in its future. High capital spending may reduce current cash flow while creating valuable capacity for later growth. This is why free cash flow should not be viewed as one isolated number. The direction, consistency, and underlying causes matter. Cash flow analysis helps separate businesses producing real economic value from those relying mainly on accounting adjustments. Once we know whether the earnings convert into cash, we can ask a more advanced question. Is the company's growth actually creating value for each shareholder? Growth is valuable only when the economics of that growth are attractive. High-quality growth can come from more customers, stronger customer retention, higher prices, new products, or expansion into new markets. Ideally, revenue grows while margins remain stable or improve, and free cash flow becomes stronger. Low-quality growth may depend on aggressive discounting, expensive marketing, repeated acquisitions, or constant share issuance. The headline revenue number may still look impressive, but the value created for each shareholder may be limited. I separate organic growth from acquisition-driven growth. Organic growth comes from the existing business. Acquisitions add the revenue of another company. Acquisitions may be intelligent, but investors should not confuse purchased revenue with proof that the original business is accelerating. Pricing power is another sign of quality. A company that can increase prices without losing many customers may have a strong product or competitive position, but price increases should be compared with customer retention and unit volume. The company may report higher revenue while selling fewer products. Share dilution is also critical. Suppose the total company grows by 10%, but the number of shares increases by 8%. The economic improvement per share is much smaller than the total growth suggests. This is why I examine revenue per share, earnings per share, and free cash flow per share. Stock-based compensation deserves the same attention. It may not reduce operating cash flow immediately, but it transfers part of the company to employees. A growing business is not automatically creating growing value for each owner. After business quality, financial strength, and growth quality have been evaluated, we are ready for a central reminder. Professional analysis is a process, not a prediction contest. If you prefer stock analysis without price predictions, one-metric shortcuts, or social media hype, subscribe to Boring Money Wins. The framework we are building is designed to slow the decision down. First, understand the business. Then, examine the competitive advantage, management, financial statements, and growth quality. Only after those steps do we ask whether the stock is attractively priced. If this video is helping you turn financial statements into a practical research process, click the like button. That helps YouTube recommend the video to more investors who want to analyze companies instead of blindly following stock picks. Good analysis does not guarantee a good outcome. Unexpected competition, regulation, economic conditions, or management mistakes can still damage the investment. The purpose of research is not to remove uncertainty. It is to understand which uncertainties you are accepting and whether the expected return compensates you for them. That is also why no single metric can complete the analysis. A low PE ratio may indicate an undervalued company. It may also indicate that earnings are expected to fall. A high valuation may be unreasonable, or it may reflect a business with exceptional growth, margins, and returns on capital. The meaning depends on the company, the industry, and the durability of the cash flows. So after understanding what the business produces and how safely it produces it, we can finally examine what investors are being asked to pay. The next step is valuation, and understanding why every valuation metric can fail when it is used in the wrong situation. Valuation connects the quality of the company with the price of the stock. The price-to-earnings ratio compares the market value of the equity with net income. It can be useful for stable, profitable companies, but it becomes meaningless when earnings are negative and misleading when profits are temporarily inflated or depressed. Enterprise value to EBITDA includes debt and subtracts cash from the valuation. This can improve comparisons between companies using different amounts of debt. However, EBITDA ignores capital expenditures. A company may report strong EBITDA while requiring enormous investments simply to maintain operations. Free cash flow yield compares free cash flow with market value. It focuses on the cash available to shareholders. But free cash flow can be highly cyclical, and one strong year should not automatically be treated as permanent. Price to sales may help analyze an unprofitable company, but revenue is not profit. A company can produce billions in sales while losing money on every additional customer. I prefer several valuation methods rather than one. I also normalize the financial results. If the company is near the top of a cycle, current earnings may overstate sustainable profitability. If it is temporarily depressed, current earnings may understate long-term potential. A professional valuation depends on assumptions about growth, margins, reinvestment, and risk. Small changes in those assumptions can create large changes in estimated value. That is why valuation should be treated as a range, not one exact price target. The current multiple also needs context. Is it high or low relative to the company's own history? How does it compare with businesses facing similar economics? Those questions lead directly into proper benchmarking. A number without context tells us very little. A 20% operating margin may be excellent in one industry and weak in another. A PE ratio of 30 may be extreme for a slow-growth utility and reasonable for a rapidly growing capital-light software business. I use 3 levels of comparison. The first is the company's own history. How have revenue growth, margins, debt, cash flow, and valuation changed over the last 5 or 10 years? Historical analysis can reveal cycles, recurring problems, and whether current performance is unusually strong or weak. The The second level is direct competitors. The comparison should involve businesses with similar customers, economics, geography, and maturity. One company may deserve a higher valuation because it grows faster, retains more customers, or requires less capital. Another may appear cheaper because it has more debt or weaker margins. The third level is the industry. Is the market expanding or shrinking? Does the business require heavy investment? Is it highly regulated? How sensitive is demand to the economy? These characteristics determine which financial metrics matter most. Peer comparison is not simply placing several PE ratios in a table. It requires explaining why the differences exist. A company with the lowest valuation may be undervalued. It may also be the weakest competitor. A company with the highest valuation may be overpriced, or it may have the strongest economics. The goal is to compare like with like while recognizing the differences that justify a premium or discount. This benchmarking process often exposes inconsistencies in the investment thesis. It also helps reveal accounting and business risks that headline earnings can hide. Those risks form the red flag checklist professionals should never ignore. One red flag does not automatically make a stock uninvestable, but several connected red flags can completely change the thesis. The first is an expanding difference between GAAP and non-GAAP earnings. Management may exclude legitimate one-time expenses, but when the same one-time adjustment appears every year, it may be part of the normal cost of doing business. Stock-based compensation is another warning. It may help recruit employees, but it also dilutes existing shareholders. I compare stock-based compensation with revenue, free cash flow, and share repurchases. A company should not claim that buybacks are returning capital when those buybacks only prevent the share count from increasing. Rising receivables also deserve attention. If revenue is growing much faster than cash collection, customers may be paying slowly, or management may be recognizing revenue aggressively. Debt pressure becomes visible when interest expense consumes an increasing portion of operating profit. Customer concentration creates another risk. A company dependent on one major customer has limited negotiating power and can lose a large portion of revenue suddenly. Frequent management, auditor, or financial officer changes may also indicate internal problems. I pay particular attention when several signals appear together. Revenue rises, adjusted earnings rise, but free cash flow falls, receivables increase, and share dilution accelerates. Each item may have an explanation. Together, they require much more skepticism. Red flags are not accusations. They are questions that must be answered before capital is committed. Once the major risks have been identified, the next step is testing how the investment performs under different possible futures, rather than relying on one perfect forecast. Professional investors do not rely on one forecast pretending to describe the future precisely. They build scenarios. The base case represents a reasonable central outcome. Revenue grows at a moderate rate. Margins remain near normal levels, and the company receives a valuation consistent with its quality and industry. The bull case tests what happens when execution is stronger. Growth may accelerate, margins may expand, and free cash flow may exceed expectations. But the assumptions should still be economically possible. The bear case examines failure. Revenue may slow, competition may increase, margins may decline, or the company may need more capital. The valuation multiple may also contract as investors demand a greater margin of safety. For each scenario, I focus on a few important variables: revenue growth, operating margin, required reinvestment, free cash flow, share count, and the valuation applied to the result. This produces a range of possible values rather than one false point estimate. The current stock price can then be compared with that range. If the price already assumes the bull case, the margin of safety may be limited. If the price is below a conservative base case value, the opportunity may be more attractive. Probability also matters. A spectacular bull case should not dominate the decision when the probability is extremely low. The same applies to a severe bear case. The objective is to understand the distribution of outcomes. A spreadsheet does not remove uncertainty. It forces the assumptions to become visible. That makes it easier to identify what evidence would confirm or invalidate the thesis. With every major part of the analysis complete, we can combine the result into one final investment scorecard. The final decision begins with business quality. Can the company's business model be explained clearly? Does it serve an attractive market? Does it possess a real competitive advantage that protects economic returns? Next comes financial strength. Are earnings converting into free cash flow? Is the balance sheet capable of surviving a difficult year? Can the company refinance its obligations without depending on perfect market conditions? Management is the third category. Has the team executed consistently? Are incentives aligned with shareholders? Is capital being allocated toward opportunities that create value per share? The fourth category is valuation. Does the current price depend on realistic assumptions? Do multiple valuation methods produce a reasonable range? Is there enough margin of safety for unexpected problems? Finally, I evaluate risk. What could permanently impair the business? Which assumptions are most fragile? How large should the position be if the analysis is wrong? The outcome can be buy, watch list, or pass. A high-quality company may remain on the watch list because the valuation is too demanding. A cheap stock may receive a pass because the balance sheet and competitive position are deteriorating. The investor does not need to own every good company. Waiting is also a decision. This framework does not eliminate mistakes. It makes the decision more consistent, transparent, and easier to review later. Understand the business, verify the competitive advantage, follow the cash flow, respect the balance sheet. Use realistic valuation assumptions. Control the position size. That is how to analyze a stock like a professional without turning the process into unnecessary complexity. And that is how boring money wins.